The collapse of Credit Suisse did not begin in 2023. That was merely the moment the body hit the ground. The real collapse began years earlier, quietly, invisibly, while the bank still looked strong from the outside, while its name still carried weight, while executives still spoke confidently on earnings calls, while clients still believed a 160-year-old institution could not simply disappear. This is how financial collapses actually happen. Not in explosions, not overnight, but through slow erosion of trust, followed by a sudden loss of confidence, followed by a liquidity event that no amount of history can stop. Credit Suisse is the perfect case study because it wasn't reckless in the obvious ways. It wasn't a meme stock bank. It wasn't crypto exposed like Silicon Valley Bank. It wasn't regional or small. It was global, systemically important, interwoven with governments, central banks, hedge funds, and sovereign wealth. And that's exactly why its collapse matters. Because if this can happen to Credit Suisse, it can happen to institutions people still believe are untouchable. To understand why Credit Suisse finally collapsed, you have to understand one brutal truth about modern banking. Banks don't fail because they lose money. They fail when people stop believing their numbers. For most of its life, Credit Suisse was considered one of Europe's elite banks. Founded in 1856, it helped finance railways, industrial expansion, and Switzerland's rise as a global financial hub. It survived world wars, depressions, currency crises, and political upheaval. Its strength was not just balance sheets, it was reputation. And in modern finance, reputation is leverage. By the early 2000s, Credit Suisse had transformed itself into a global investment banking powerhouse. Trading, prime brokerage, structured products, wealth management for the ultra-rich. These businesses generate enormous profits when markets are calm. They also generate hidden risk when incentives reward short-term returns over long-term survival. The first cracks didn't come from one catastrophic bet. They came from culture. A culture that rewarded aggressive risk-taking while assuming Swiss prestige would always provide cover. Credit Suisse began taking on clients other banks quietly avoided. High-risk hedge funds, politically exposed individuals, complex derivatives, structures that generated fees but obscured exposure. This wasn't illegal. It was dangerous. The warning signs were there long before the collapse. Between 2015 and 2020, Credit Suisse was hit by repeated scandals, sanctions violations, espionage allegations involving executives spying on former employees, regulatory fines, money laundering accusations. None of these killed the bank, but each one chipped away at trust. Internally, risk controls weakened. Externally, regulators became more suspicious. Clients began asking harder questions. Then came the turning point. Archegos. In 2021, Credit Suisse suffered one of the largest losses in its history due to the collapse of Archegos Capital Management, a family office run by Bill Hwang. Archegos wasn't a hedge fund. It was worse. It was opaque, leveraged, and largely unregulated. Credit Suisse acted as prime broker, extending massive leverage to Archegos through total return swaps. These instruments allowed Archegos to build enormous positions without disclosing ownership. When markets turned, Archegos imploded. Credit Suisse lost over $5 billion. This was not just a loss, it was a revelation. Other banks had exposure to Archegos, but they moved faster. They demanded margin. They cut risk. They exited positions. Credit Suisse hesitated. That hesitation revealed a deeper problem. The bank did not have real-time visibility into its own risk. In modern finance, that is fatal. The Archegos collapse shattered the illusion that Credit Suisse had its risk under control. Investors realized something unsettling. If this bank could lose billions on a single client, what else was hiding beneath the surface? Then came Greensill. Another blow. Credit Suisse had heavily promoted supply chain finance funds linked to Greensill Capital, presenting them as safe, low-risk investments to wealth management clients. They weren't. When Greensill collapsed in 2021, $10 billion in funds were frozen. Clients were furious. Trust evaporated. Wealth management is built on confidence. Clients don't tolerate surprises. And once wealthy clients start questioning whether a bank truly understands its risks, they don't wait for answers. They leave. This is where the collapse becomes non-linear. Banks don't bleed slowly forever. They reach a tipping point. By 2022, Credit Suisse was already wounded, share price collapsing, leadership turnover, regulatory pressure increasing. Cost-cutting programs announced with the desperation of institutions trying to buy time. But the real danger wasn't losses. It was deposits. As rumors spread, clients quietly began moving money out. At first, this outflow was manageable. The bank insisted liquidity was strong. Capital ratios met requirements. On paper, Credit Suisse was solvent. In reality, it was fragile, because banking is not about solvency, it's about confidence. In October 2022, that confidence cracked publicly. Social media speculation, analyst notes, headlines questioning Credit Suisse's viability. Executives went on television to reassure markets. That reassurance had the opposite effect. When banks feel the need to reassure, investors assume something is wrong. Depositors accelerated withdrawals. By the end of 2022, Credit Suisse had suffered over 100 billion Swiss francs in net asset outflows. That is not a leak. That is a run. And once a run begins, logic no longer applies. It doesn't matter how long a bank has existed. It doesn't matter how many crises it has survived. If everyone believes everyone else is about to withdraw, they withdraw first. The final blow came in March 2023. Silicon Valley Bank collapsed in the United States. This triggered global anxiety about bank stability. Investors and depositors everywhere started asking the same question: which bank is next? Credit Suisse was already wounded, already bleeding deposits, already under scrutiny. Then its largest shareholder, Saudi National Bank, publicly stated it would not provide additional capital. That sentence alone was enough. Markets panicked. Credit Suisse's share price collapsed. Credit default swaps spiked. Within days, the Swiss government faced an impossible choice: allow Credit Suisse to fail or intervene. They chose intervention. In an emergency weekend deal, UBS was forced to acquire Credit Suisse, backed by government guarantees and central bank liquidity. A 160-year-old institution ceased to exist. Not through bankruptcy, not through liquidation, but through absorption, erased. What makes Credit Suisse's collapse so important is not that it failed, it's how it failed. This was not a sudden black swan. It was a slow-motion disaster disguised by complexity, reputation, and regulatory comfort. Every stage was visible in hindsight. Cultural decay, risk blindness, scandals, client distrust, deposit flight, liquidity crisis. The same pattern repeats across financial history. And it raises an uncomfortable question: how many other institutions look stable until they don't? Credit Suisse didn't collapse because it was unlucky. It collapsed because modern banking is built on leverage, speed, and belief. And belief can disappear faster than capital can be raised. That is the real lesson. In today's financial system, trust is the currency. Once it's gone, even a 160-year legacy means nothing. If you want to understand where the next cracks might appear, you need to stop watching balance sheets and start watching confidence. Because history shows us this again and again. Banks don't die when they run out of money. They die when people decide not to wait around to find out. And when that moment comes, the collapse is never slow. It is immediate, it is absolute, and it is final. If you want to stay ahead of these events, understand the patterns, and recognize the warning signs before they hit headlines. This is exactly what the Crisis Archive Financial exists for. Subscribe, because the next collapse will not announce itself either.